Hello, good evening. This is Nanama. This is the next in my series of videos on why investing matters. Today, I want to focus on equity funds and as a category. I have touched briefly on equity funds previously, but it was just very briefly. So today, I just want to go into it much further. So investing directly into companies can be quite risky, although it is very rewarding with very high dividends, high capital growth. But then you need a lot of uh, capital to be able to diversify your risk easily. To help mitigate these risks, you could also consider investing in equity funds. Equity funds are mutual funds that focus primarily on equities as compared to having a portfolio holding of bonds, gilts, etc., or a mixture. Equity funds can be categorized by market cap, where certain funds will focus on either large cap, mid cap, or small cap. They could also be categorized by the investment style, which reflects the fund's share categories. Some funds also focus on specific sectors like healthcare, tech. You could have oil and gas, retail, the food sectors, minerals, etc. There are also other categorization based on region. So you could have a fund which is focused on emerging markets, maybe on Africa, maybe on Ghana, maybe on a particular region, or it could be Asia, it could be America, or it could be Europe. You could also have it quite global or emerging market or BRIC countries, but typically you've got global emerging markets, that sort of thing. And then some of the pros of equity funds are they're ideal for those without a large amount of capital to invest. It also enables you to be exposed to a lot of companies quite easily in a short time. Due to the small capital requirement, it enables small investors to diversify their portfolio quite easily. It also which inherently enables them to reduce their risk, something which you are not able to do easily in direct shareholding without having large capital to invest. On the downside, equity funds can be quite costly as there are management fees charged for administration. Pricing. Equity funds are priced based on their net asset value less any liabilities. A highly diversified fund means no single share or stock price movements can influence the overall fund share price. Active versus passive funds. Active funds have managers running or making decisions on the fund's holdings, whereas passive funds typically track other indices. Like shares, you can make money in funds through dividends and capital gains. Dividends are typically paid twice a year, whereas capital gains arise from selling your funds at a higher price than purchase. In the UK, dividends are tax-free up till 2k and capital gains are tax-free up till 12.3k. You can purchase equity funds from most brokerage and fund houses through brokers or dealers, or more easily by yourself via investment platforms like Hargreaves, iWeb, Share Center, etc. Some of the brokerage houses have a lot of funds managed by themselves as well as other houses, which they provide research or even publicize a ranking of funds on. Just to recap, equity funds. So this is a type of mutual fund that focus primarily on equity. So you can have a fund set up with which can have mix of fixed income or equities. But with equity funds, it's most of the time 80 to 90% or even 100% all equities. These could be categorized by global or emerging markets or maybe specific industries or sectors, and also categorized by market cap. The plus side of these things, it enables small investors, retail investors to dip into, get exposed to large large or a lot of companies quite easily, and also reduce their risk, as going directly into companies can be quite costly. The downside is it can be quite costly, as there are fees, ongoing fees to managing or administering the fund. I'd like to stop here for today. Thank you very much. As always, if you have any questions, do email me amapoks1982@gmail.com. Thank you and good night.